Look, I get it. You've been running your own business for years. You have a steady income and maybe even some extra cash sitting in the bank collecting dust. But that is why you stay up late and trade your time for dollars. And the treadmill never stops. If I tell you, is there a completely different path? A path where your money works harder than you do. In fact, a path where you're really sleeping and your net worth is growing. Welcome back to channel. If you're new, I'm glad you clicked because the information we disclose today could fundamentally change your financial trajectory. We're talking about how small business owners like you quietly turn a hodgepodge into a multi-million dollar real estate empire. The crazy part? Most people don't need trust or lucky people. They only know the difference between the rich and the rest. So stay, because at the end of the video, you know what to do. Before we talk about strategy, we need to talk about timing. And timing, my friend, is everything about real estate. Here are the realities of late spring 2026. The US housing market is doing something it hasn't done in years. It is actually starting to favor buyers again. If you're a business owner with money and cash flow, you sit well. Let's look at these numbers because they don't lie. House price appreciation has nearly stalled. We were talking about 0.4% year on year growth. On the surface, it sounds bad. And if you're already a homeowner you want to admire, yes, it can be stinging. But think about what that means for you as an investor. That means prices are stabilizing. Bidding war and inspection exemption day, it basically disappeared. So what about days when real estate fluctuates by more than 10% in 24 hours? This is the memory of 2021. What fills the void? Inventory. We have now seen 28 consecutive months of annual inventory growth. We currently own 1.23 million homes on the market. That is your choice. That means you can shop around, you can negotiate, you can actually find real estate with potential rather than settle for anything that comes first. But for someone with business and money, that is what is really interesting. Mortgage rates are still rising, but stabilizing. The Fed hinted that interest rates could remain in the range of 3.5% to 3.75% for the foreseeable future. Now, yes, that is above the historical lows we saw in 2020 and 2021. But the hidden advantage is that everyone else is terrified by it, a psychological barrier that prevents retail and amateur speculators from entering the market. For those who know how to act, less competition means better deals. Let's talk about something that directly affects you as a business owner. Affordability is finally improving. This is the first time in 3 years that we have seen a significant improvement. Typical mortgage payments are now 4.4% lower than they were a year ago. For middle-income families, that means about $20,000 in additional purchasing power. What if your revenue exceeds the median? You just unlocked properties and markets that were completely out of reach 6 months ago. One thing is really worth noting. 24 million American families are now worth more than $1 million. A third of those wealth milestones have occurred since 2017. What created this wealth? Real estate, my friend. Real estate. Not a stock portfolio. Not encryption. Not off track. The rental market is also leveling off in favor of investors. Apartment rents are expected to rise only 0.8% year on year. Single family rents rose 1.8%. For decades, we were told rents were always rising. But what happens when rent growth slows? That means your return on cash becomes more attractive. That means the gap between home prices and rental income has widened. That means your window of opportunity is open. So, why should I tell you this? Because if you're a business owner sitting on a fence, you think it is definitely time. The market has shifted from speculators to strategists. If you're smart and purposeful, you can build real things. Before we get into the real estate buying system, I need you to understand some basic things. As a business owner, you have advantages that W-2 employees don't have at all, and most never took advantage of them. 1. Your cash flow story is compelling. When you walk into a lender's office as a small business owner, you're not just another borrower. You've shown that it takes years for most people to figure out that you can generate income. You can start from scratch. This is important for lenders, especially those focused on investing in real estate. Here is what happened in 2026. There are now specialized investment real estate lenders buying business owners. Companies like Kiavi, Vision Lending, Lendingone, and Corvest have completely reimagined how to work with small investors and entrepreneurs. These aren't your grandmother's mortgage companies. They are tech-enabled. They moved quickly. Crucially, they understand that business owners tend to earn more reliably than W-2 earnings. Think of a company SW-2 employees. Of course, they already have written job guarantees. But how long will this last in the AI economy? At the same time, you have the means of production. You can adapt. You can scale up. You can turn around. Second, leverage. Every business owner has leverage. If you've ever taken commercial loans, financed inventory, or extended credit to customers, you know how to use other people's money to expand your returns. Real estate loans are the same concept, but in different areas. The lending products now available make such leverage more readily available. DSCR loans, or debt service coverage loans, are one of the most powerful tools you can use. Here is how they work. Instead of letting lenders look at your income and decide what you can borrow, they look at the projected rental income of the property as a basis for determining your ability to borrow. As a result, a rent of $1,200 a month may qualify you for a much larger loan than a traditional lender would approve. Betting on the property's ability to pay for itself. For business owners, it is a game changer. Why? Because it separates your ability to borrow from your personal income. You can have $1 million in business income, but if your business somehow sets up a tax return like a good accountant, it may not be like the $1 million in personal income of a traditional lender. The DSCR loan bypassed the problem entirely. Repair and flipped financing is another lever. If you already have a business, you know about renovations, project management, and PSIL. You're not afraid of repairmen. In fact, you may see potential where others see disaster. At present, fixed and flipped loans have maturities of 12 to 24 months and loan cost rates of up to 90 to 100%, depending on the lender. That means you could fund almost all the renovations. A property that scares retail investors. It is a payday for those who know how to manage and execute projects. Third, you can get money that others don't have. It is subtle, but important. As a business owner, you have a choice: commercial, credit line, redirectable, device, loans, private lending networks. Other successful entrepreneurs know each other. Partnership capital from other business owners who respect the business you build. Employees, they locked in salaries and perhaps some home equity. And you have multiple potential cash flows that a mortgage company may not even know exist. Fourth, your time is more flexible than you think. Yes, running a business takes time, but it also teaches you how to delegate, systematize, and build teams. Most of the owners you'll encounter in this space are trying to manage everything on their own. They are bottlenecks. You already know how to get out of this trap. You can hire a property manager based on a percentage of the rent. You can hire contractors who already have connections. You can hire accountants and tax strategists to maximize your structure. This is crucial. For every dollar you pay a professional to systematize your real estate operations, you'll be tax-free and save hundreds of hours. A reasonably structured business owner can own 10, 20, 30, or more properties and spend less time on them than employees commute. Finally, your mindset is different. Running a business teaches you something that most people will never know: the difference between investing and consuming. When you spend $50,000 on that software system, you don't think you spent $50,000. You think, what will this bring me? That is what investors think. That is the empire building mentality. Employees see rental properties as homes they must maintain, nightmarish tenant conditions, or money pits. Business owners treat rental properties as income generating assets with a monthly rent to price ratio of at least 1%, meaning $200,000 properties should attract more than $2,000 a month. What if that threshold is not met? This will not lead to portfolio reduction. It is a filter that separates wealthy business owners from those in trouble. Okay, so you believe it. The timing is right. You know your strengths. Now everyone wants to know, how did you do it? I will break down the blueprint for working for business owners in 2026. This is not theoretical. These are aggressive money-making strategies. Phase 1, cash flow optimization. 1 to 3 months before you buy property, you need to plan your business to specifically raise money for real estate purchases. It is not sexy, but it is basic. Look at your business. Really, you may be rich, inefficient operation, non-stop spending, income disparity. Optimize relentlessly over the next 90 days. Automate as much as possible. Authorize what you should do and delete what you don't need. The goal here is not to grow your business. Increase cash flow margin by 10 to 20%. That could mean an additional $2,000 to $5,000 a month. That is your capital allocation fund. This is important. You need 12 to 18 months of capital reserves to buy your first house. Why? Because you will encounter unexpected repairs, turnover, and vacancies. If you don't have reserves, the problem could turn into a financial disaster. Most skipped that step. They were impatient. They made direct real estate purchases. Then they bought properties that looked good on spreadsheets but couldn't survive in reality. Don't be that kind of person. Phase 2, education, 2 to 4 months. When you accumulate cash, you need to teach yourself. I mean, really educating myself, not just watching a few YouTube videos. Understand these metrics: cap rate, capitalization rate. This tells you the annual rate of return on a property. The formula is net operating income divided by property value. You want this to be at least 5 to 8% in most markets. Below that, you may not be rewarded. Cash return, that is the actual return you put in. If you invest $50,000, after deducting all expenses, the property generates $8,000 a year in cash flow, or 16% of the cash to cash return. Great. 1% rule. Monthly rent should be at least 1% of the total property price. So a $200,000 house should rent for at least $2,000 a month. It is a quick screen for deals. Coverage, monthly rental income divided by monthly debt payments, mortgages, taxes, insurance, repairs, vacancies. You want that to be above 1.25, below 1. The property is underwater from a cash perspective. Make good use of these numbers. Business owners should be able to evaluate a property in 15 minutes and know if it is reasonable. Most took weeks, but they were wrong. Stage 3, market selection. 3 to 5 months. That is where your business owner mentality gives you a huge advantage. For business expansion, you should do market research and other market choices. Now, in the spring of 2026, the best market for investors to buy and hold. Presence, unique characteristics, high inventory, more options. Price appreciation stabilizes, less competition from page flippers. Rent is more attractive than cash flow. The local economy is growing, employment growth, population growth. Major markets include Huntsville, Ala, median $32,500. Techie aviation boom, Birmingham, Ala, median $17,900. Growing healthcare centers. San Antonio, Tex, median $35,700. Still rising Austin job market access, Tex, and several Midwestern markets, including Indianapolis and suburban Chicago. But here is the thing. Don't just pick one market. Understand the market. Go there for the weekend. Pay $300 for airfare and hotel. Drive the community. Talk to your local property manager. Study unemployment, population growth, and business migration. Business owners understand that they cannot enter new markets without understanding the fundamentals. Most real estate investors never did. They just look at the spreadsheet and click buy. Then they want to know why their investments are underperforming. Phase 4, acquisition strategy. Now you can start looking. This is where leveraged products come in. For your first property, buy cash flow rent. This is not a lovely time. You're not flipping. You're not looking for appreciation. You're building a foundation. The first attribute of perfection is single family or small family, 2 to 4 sets. Full or easy leasing meets 1% rule. Positive cash flow from day one. In the job growth market, you are looking for something that generates positive cash flow of $500 to $1,000 a month, including all expenses, mortgages, taxes, insurance, maintenance reserves, vacancy allowances, property management. That doesn't seem like much. But here is the beauty. A rent of $700 a month generates $8,400 a year in passive income. More important, it is a proof of concept that proves you can be a landlord, that proves you understand numbers. It is ready for your next move. For this property, you might consider putting down 20 to 25% of the loan and refinancing the rest. That is where the SCR loans become your best friend. If the property's cash flow is strong, lenders will exceed traditional income requirements. Suppose you find a $250,000 property for $2,500 a month. Mortgage repayment approximately $1,150, 6.25% per month. Taxes, insurance, repairs, vacancies, approximately $650 a month. Net cash flow, approximately $700 a month. Cash return, if you invest $50,000, your annual return on capital is 16.8%. It is not just better than the stock market, that is significantly better. This is using the properties of the checked basic box. Now multiply by 5 to 10 properties in 5 to 10 years. And you, LLC passive income of $35,000 to $70,000 a month. This is the real empire state building. Phase 5, leverage and scale. This is where business owners are absolutely dominant. Once your first 2 to 3 properties generate steady cash flow, you have a proof of concept. You have a track record. Suddenly, cautious lenders have become more aggressive. You can deploy more sophisticated strategies. HELOC, home equity credit line of your primary residence. If you have lived at home for many years, you are likely to have considerable interest. You can take advantage of this at a higher interest rate than an unsecured loan or credit card. Some investors see it as a major source of funding for the next 3 or 5 acquisitions. Portfolio loans. Lenders like Corvest tie together multiple properties, giving you better terms than you get a loan. Once you have a steady rent of 3 to 4 units, you can use them. You might refinance them all into a big loan, take out the initial capital, and distribute it to the next property. Restoration and turnaround schedules. If you have business experience in renovation and project management, it is exciting. You can identify distressed properties, renovate them, refinance them into permanent leases, then collect the money and do it again. Some investors use this model to buy 2 to 3 properties a year. The mathematical reality is shocking. If you buy a house for 5 years a year for an average of $250,000, 20% per property, $50,000 equity per property. Each property generates $700 a month in cash flow. The annual increase per property was 2.5%. By year 5, ULC, 5 properties worth about $1.45 million. Generate $4,200. Sign month, passive cash flow. Cumulative equity of about $550,000. Down payment, appreciation, down payment. Here is a secret nobody talks about. Equity becomes capital for your next phase of growth. You take the HELOC of these 5 properties and offer $200,000, and suddenly you are no longer constrained by your monthly cash flow. You deploy capital on another timeline. Phase 6, tax strategy. This is where your business owner background becomes gold. A good business owner works with a good accountant, but most business owners don't realize that real estate tax treatment is completely different from W-2 or even most corporate income. With real estate, you get depreciation deductions. Even if your property is appreciating, you can claim building depreciation, a non-cash expense that reduces your tax liability. Fee deductions, mortgage interest, property management, repairs, utilities you pay, tenant advertising, etc. 1031 exchange. The ability to swap one investment property for another without triggering a capital gains tax. Business owners with a well-structured $200,000 real estate portfolio may be able to reduce their taxable income to $80,000 to $100,000 through depreciation and expenses. This is not tax evasion. This is a tax code intended to be used. The key is to have real estate accountants, not just anyone. This person should be involved in your real estate acquisition decisions, not just paying your taxes at the end of the year. Most people think in reverse. They buy real estate and then try to optimize taxes. Smart merchants optimize their structure before buying. Now, I want to be honest with you. I just gave you a roadmap to real wealth, but there are some real obstacles between that roadmap and actual implementation. If you're not ready, they could derail you. Obstacle number 1, your business could suffer. Here is the reality. When you're building a real estate empire, you can't look away from business. Your business is the source of financing for your real estate purchases. If your business falters, the whole plan stalls. That is why the systematization phase is non-negotiable. Before buying a property, number 3, you need to run your business without day-to-day involvement. That means documented processes, authorizations, and systems that others can execute. Some business owners are good at it, others are not. Be honest with your category. If you're the kind of person who has to touch every decision, you're not ready to expand real estate. Grow your business to the point where you're not needed, and then expand real estate. Obstacle number 2, tenants from hell. I won't whitewash it. Bad tenants are real. A property that is supposed to generate $700 a month can easily lose $2,000 to $3,000 if the tenant goes wrong. How to alleviate this situation? Ruthless lockdown. Background checks, credit checks, employment checks, references to previous landlords. It is not paranoia. This is due diligence. Use property management. Yes, it is expensive. A good property manager charges 8 to 10% of the rent, but they will be better screened, better executed, and cope with the emotional burden of evictions. A monthly fee of $200 can save you more than $2,000 in losses. Overspending, maintenance, reserves. Each property should have a maintenance reserve equivalent to 5 to 10% of the annual rental income. $2,500 a year in a separate account can save you in a crisis. Obstacle number 3, negative cash flow. Market cash flow in the spring of 2026 was much better than 18 months ago. But that doesn't mean you can't make mistakes. Some markets still have reverse rent price ratios. You can buy a property for $400,000 and rent it for $1,800 a month. On paper, it won't work. Mortgage payments alone cost $1,900 a month. I don't care what the spreadsheet says. Real estate is exhausting. The solution is discipline. If a property doesn't meet your minimum 1% rule, you don't buy it. There are no exceptions. Future appreciation is not rationalized. Appreciation is a dividend. Cash flow is the foundation. Obstacle number 4, access to funds. That is where many people are in trouble. They bought 1 or 2 properties, and suddenly it was hard to get more money. Why? Because traditional lenders have loan restrictions. They won't lend you money indefinitely just because your current property is in good condition. That is where you need creativity. HELOC at your main residence. Leverage commercial lines of credit. Looking for private lenders, other successful business owners, joint ventures with capital partners. Learn about new products like portfolio loans I mentioned. If you're stuck in 2 or 3 properties and feel like you're not growing, it is usually because you're not exploring other sources of funding. Most just gave up. Obstacle number 5, time management. Yes, you can run a growing business and directly manage more than 20 rental properties. That is impossible. The solution is to accept that you have to pay professionals to manage your property. Yes, it erodes your cash flow. But another way to try to manage everything yourself could put your business and real estate portfolio in trouble. A business owner should think differently. If I pay the property manager $200 a month, but it saves me 10 hours a month, is it worth it for my business to generate $200, negative $300 an hour? Of course, you didn't lose money. You are allocating capital to buy time that can be reallocated to the business, which will generate more capital and reallocate it to more real estate. This is exponential thinking. Most people think it is linear. Let me use the current market situation in April 2026 to show you what this looks like in real numbers. Moderate trajectory. Let's focus on a 45-year-old business owner. We would call her Sarah. She runs a $150,000 a year service business, not fancy, but stable. Year 1, Sarah optimized her business, improved cash flow, and saved $60,000. She found a duplex in Round Rock, Texas, for $380,000, 2 of which cost $1,300 each. Total, $2,600 a month. Mortgage payments, $1,450, taxes, insurance, repairs, vacancies, $800, net cash flow, $350 per month. She set aside $80,000 to raise $300,000 through a DSCR loan at an interest rate of 6.25%. Her passive income is now $4,200 a year. The next year, her real estate earned another $4,200. Her business generated another $60,000 in usable capital. She bought a second home in San Antonio for $295,000, a single-family home for $2,100 a month. Property $1 to $350 funded. Property $2 to $420 funny month, total $770. Funded month, passive income $9,240. Send year. Year 3, business capital $60,000. Real estate revenue $9,240. Total funds available $69,240. She bought a third property. Year 4, her portfolio now makes $14,000 a month in real estate. Revenue $60,000. She is deploying more than $74,000 and buying her 4th home. Year 5, Her portfolio is now worth about $1.3 million. Her passive real estate income exceeds $27,000 a year. Her interest in the properties ranges from $450,000 to $500,000. Here, she has a choice. Continue to buy 1 to 2 properties a year. Eventually, her real estate income exceeds her business income. Buy HELOC with her shares and accelerate the acquisition. Shift business to a more passive model, focusing entirely on real estate. Live on real estate income after retirement. By age 55, if she continues on this trajectory, she can actually own a real estate portfolio worth $2.5 million to $2.5 million, generating more than $60,000 to $80,000 a year in passive income. Radical trajectory. Now, let's see what happens if someone is more aggressive. Instead of buying 1 property a year, they buy 2 or 3 properties a year, combining personal capital, business capital, HELOC equity, and portfolio lending strategies. Same starting point, $150,000 business, $60,000 find year available funds. But this person deduct $150,000 from HELOC from their first year's primary residence, add $60,000 and make a down payment of $210,000 for 2 or 3 properties. The next year, their initial wealth appreciated and their rights arose. They used portfolio loans to refinance, divest, and redeploy the original 2 to 3 properties. They now have $200,000 to $250,000 to buy in years 2 to 3. By the third year, they owned 6 to 8 properties. By year 4, they owned 10 to 12 properties. By year 5, they owned 14 to 18 properties. Portfolio value, $3 million to $4 million passive return, $100,000 to $150,000 Civian annual equity, $800,000 to $1.2 million. What is the difference between moderate and radical trajectories? Mainly leverage and willingness to work hard for 1 to 3 years. And management. Now, let's talk about your primary residence. There is one thing that few people talk about here. If you own your own home, you already have the most valuable real estate expansion tool. Suppose you bought a house 10 years ago for $400,000. You've paid off your $150,000 mortgage. Your house is now worth $500,000. That is $250,000 in equity. You can get this information at 7.5 -8% interest through HELOC. Yes, it is higher than your mortgage rate, but if you apply it to real estate with yields of 8 to 12%, it is a good deal. HELOC is essentially a $250,000 fund that accelerates your real estate acquisition. Some investors see it as a major source of funding for the first 5 to 10 properties. But here is the problem. You have to respect that influence. HELOC is a mortgage. If you default, you lose your home. So you won. Touch the money unless you are 100% confident it is going to flow into a property that can pay off its debt with cash flow. Wealth acceleration moment. The most critical moment in the journey takes place in about 4 or 5 years, when your passive real estate income begins to exceed your business income. This is the inflection point. At this point, you have a decision. Continue to run your business while expanding your real estate compounding stage. Step back and focus entirely on real estate acceleration phase. Sell your business, and put all your money into real estate index phase. Different people make different choices here, but the important thing, you have a choice. The choice comes from following that blueprint. Most never reach that inflection point because they never start. They're stuck in a linear mindset. I work, I get paid, I spend, I want to change. Never. But what if you follow this framework? What you see is legitimate wealth accumulation, not lottery wealth. Don't get rich fast. Real estate, compound, and index wealth. I want to spend a few minutes on something that can be both your best friend and your worst enemy, real estate financing, because the lending landscape for investment real estate has fundamentally changed. If you tried to get an investment real estate loan 18 months ago, it would have been tragic. The interest rate is 8 to 9%. Lending standards are crazy. You need to fall 30%. It is cruel. In 2026, the situation improved significantly. Imperfect is better. The main players, you should know, Kiavi rarely lends in all 50 states. They offer fixed and flipped loans, DSCR loans, and portfolio financing. They can close the deal in a week. The minimum credit score is 640 to 680, depending on the product. If you buy and hold cash flow, Kiavi is worth mentioning. Vision loans focus on DSCR loans. These loans are based on your rental income, not your personal income. If your business structure is such that your personal W-2 income does not reflect your actual earning capacity, a DSCR loan is your workaround. The BBB rating is buoyant, and the customer rating is positive. Lendingon focuses on customer service and works with emerging investors with 1 to 5 properties. If you're new, it is probably the most comfortable introduction to an investment real estate loan. Corvest and Lima 1 are for more experienced investors who already have portfolios, but they are worth knowing because their portfolio lending products are incredibly scalable. Key indicators you need to know: debt service coverage ratio, DZCR. This is the ratio of monthly income to monthly debt payment of the property. If a property generates $2,500 a month in rent and pays a mortgage of $1,800, the DSCR is 1.39. Most lenders want a DSCR above 1.25. Below that level, the property cannot generate enough income to easily pay its debts. Red flags. LTV. How much money did you borrow relative to the value of the property? If you borrow $240,000 on a $300,000 property, your LTV is 80%. Most leases require a down payment of 20 to 25% or 80% LTV. Some banks, ROEs, loan to cost ratio, LTC, for construction or maintenance and turnover. This is the borrowing relative to the total cost of the project, procurement, renovation. 90% LTC means you have to fund 90% of the total cost of the project. This is common in fixed and flipped loans. Interest rates. As of April 2026, the DSCR loan interest rate of investment real estate loans was 6-7.5%, and the fixed and flipped loan interest rate was 7-8.5%. Yes, they are higher than mortgages, in the range of 6 to 7%. Why? Because investment real estate is more risky. The biggest mistake people make in borrowing, they optimized Minimum interest rates. The wrong move. You should optimize the terms of your strategy. Closing speed. Flexibility for future acquisitions. Lenders who will work with you on the next deal. If you buy and hold cash flow, raising interest rates by 0.5% is not important if it means you can complete delivery in 10 days instead of 45 days and rent faster. If you are flipping, you need a lender. And if number one succeeds, he will soon fund your next deal. Lenders know that good listings offer discounts on your second, third, and fourth homes. They want to work with you again and again. What to bring when talking to lenders. Personal income tax returns for the past 2 years. Business tax return for the past 2 years. Financial statements of the company. Bank statements showing capital reserves. Details of any existing real estate holdings. A description of the property you want to finance. Don't go in blindly. Get ready. It shows that you are serious and informed. What no one tells you about building a real estate empire is that the financial system is actually the easy part, and the difficult part is psychological games. You see things that make you question everything. A property you buy for $250,000 could depreciate to $235,000 in 18 months. Your tenant will miss the rent. A water heater will burst and cost $3,500 to replace. The vacancy period can hit you when you don't expect it, and your human instinct, is panic. For sale. Go out. Go back to the comfort industry where you control everything. Don't do that. The problem. Real estate is not a tool for getting rich quick. It is a compound wealth tool. You are not trying to flip a property for a 30% return. You are trying to buy a property with an annual cash return of 10 to 15% and keep it for 10, 20, 30 years. In its first year, it created $3,500. The next year, it created $3,800. Rent increases. In the third year, it created $4,100. In year 10, it created $6,000. At the same time, you've made a down payment on your mortgage of $240,000 to $180,000. The property has appreciated to $375,000 from $300,000. By year 10, you LLC $375, zero in assets, $180,000 in liabilities, and $195,000 in equity. The property, which had little cash flow in its first year of trading, has compounded into a huge fortune, but you have to persevere. Foreign exchange, reserve, strategy. Here are some ways to stay sane when things go wrong. You overspent your reserves. Each property should have a separate reserve from the checking account. For every dollar of monthly rent, you set aside 5% for maintenance and repair. Vacancy rate 3%. Capital improvement 2%. So the rent of $2,500 a month leaves a reserve of $250 a month. $3,000 a year. Most months, you don't touch it, but when the water heater breaks down or you have 2 months of empty space, the reserve absorbs it. Real estate won't start draining your personal cash. It is boring and not sexy, but that is the difference between investors who survived a recession and investors who panicked and sold at a loss. collaboration trap. Here is a tip that could save you hundreds of thousands of dollars. Be very careful in real estate partnerships. I know you bring capital, I bring sweat equity. You do business, I do real estate. We will be partners. That sounds great. But partnerships are like marriage. When all goes well, everything is seamless. When things get bad, and always bad, they sometimes turn into nightmares. Who pays for repairs? Differences over whether to sell. One partner wanted to withdraw money for a personal emergency. If you plan to build a partnership, be cautious and have a very clear legal agreement. I would recommend a real estate lawyer, not just any lawyer, for any partnership you consider. Better leverage, not partnerships. HELOC and commercial loans can make you a lot of money without the legal complexities of a partnership. Burnout. When you expand from one property to 3, 5, or 10, you end up feeling overwhelmed. Your business is demanding. Your property is demanding. Your life is hard. This is when you need to be brutally honest with yourself. Am I doing this to accumulate wealth or to motivate myself? In the former, you can scale up and authorize. You have a property manager, you have a bookkeeper. Everything is automated. You create systems that don't need you. In the latter case, if you like to tell people privately that you own 10 properties, but can hire a property manager because you want to maintain control, you are weakening yourself. You'll be exhausted. Your property will be affected. Your returns will fall. Call early, build the system, delegates, or accept that you own only a few properties and focus on building truly great properties. There is no shame in either option. Pretending it is not an option is the only shame. Listen, I know what you're thinking. You're here thinking, I'll give you some amazing recipes, some secrets that no one else knows. The truth is, there is no magic formula. What works? Discipline. Before entering real estate, optimize business and accumulate capital. Pattern recognition. Understand the criteria and patterns that distinguish between deals and disasters. Leverage. Learn how to use other people's money wisely. Time. Accept that this is a journey of 10 to 20 years, not 2. Systems. Build an operation that doesn't require your personal time. Patience. Cyclical real estate holdings, not panic selling. If you're bored, real estate may not be for you. There are many other ways to make money. Intra-day trading, cryptocurrencies, start-ups. But if all of this resonates with you, if you're a person who understands that exponential returns come from compounding and time, then this path is absolutely open to you. Here is the beautiful part. You're a business owner. You don't start from scratch. You've proved you can generate income. You started from scratch. You already know leverage, systems, and profit margins. You just need to redirect those skills to a new field. Here are the challenges I want to leave you with. Over the next 30 days, I want you to do 3 things. 1. Audit your business. Find where the money leaked. What is the cost of this inefficiency? What if you could recover 10% of your current operating profit as available capital? 2. Spend 2 to 3 HRs learning indicators. The 1% rule, cap rate, DSCR, rent price ratio. Master the numbers. 3. Identify 3 markets you are interested in. Where do you want to own property? Why? Starting to study these markets is like studying new business opportunities. All 3. Don't buy. No big promises. Just prepare for opportunity. Because I promise you, if you know the indicators, have money, find a good market, opportunities will come. When it shows up, you're ready to deploy. The people who built real estate empires are no smarter than you. They are no luckier than you. They were not born rich. They just decided to get started. Then they maintained discipline long enough to get the job done. You can do the same. If the video is valuable, leave a message. Subscribe. Share this with business owners you know who are interested in it. If you've already started your real estate trip, I'd like to hear it in the comments. What was your first property? What surprised you? What would you do differently? Thanks for watching. See you next time.